gravy, like that submarine. The markets are starting to just dive down, and people are hoping it resurfaces into a new bull market rally, a new all-time high, maybe driven by the bottom half of the S&P, those stocks that haven't just rallied yet, because tech, AI, that has just been pumping us to the moon in a time where fundamentally revenues are literally declining or going down at a level we haven't seen in quite some time. So are we going to hit a brick wall in these next earnings? That's a question we kind of got to ask ourselves here, folks, as I'm going to be giving you clerical insight into why I'm selling a ton of my investments, why I'm going to be buying a ton of individual investments, stocks, not financial advice. It's just what I'm doing, what part of the markets I'm looking at. We'll talk about these Canadian dividend stocks. Some of these things AAA rated, yielding damn near 6.5%. Some of them are just going insane. Are they a buying opportunity? Is there something you should be concerned by? I'm going to try and answer all these questions and more as we even talk about the Canadian real estate market. So consider hitting that like button, because I feel like we're living in one of the most interesting financial times of my entire life. Now, before we look at the markets, what am I doing with my portfolio? As many of you know, you OG subscribers, yes, I've been selling my ETFs. Am I going to sell them all off? No, I want to keep my S&P. I want to keep SCHD. You should be cost averaging into these, but I want to buy real estate. This is a time in my life where I recognize there are people struggling. Real estate doesn't see the same volume in sales that it saw, but it's still moving, and I just want to be able to live comfortably around my family. So we are going to come up with a very sizable down payment. We're going to try and find something and see if we can get a hold of it. And I'm going to be figuring out over the next week how much of my stocks I want to sell off for that down payment. And then I'm going to adjust the portfolio based off that. And I'm going to start purchasing individual stocks that personally interest me. And we'll talk about those stocks in this video. We're also going to talk about if I think the Canadian real estate market's going to crash. We'll get back to that in a uno moment, because I mean, considerably my portfolio is flat as of last week. This week we're down $5,000 again. Not the best. You know, we're heading into a cyclical pullback here, folks, because of this rally has just been too out of control. And I've told you this many times. You can't be seeing these unbelievable rallies in a time where revenue just isn't exploding like it was. I mean, we mentioned that the Qs are more expensive now than they were in 2021 at their peak, because revenue growth isn't there anymore. EPS growth isn't there anymore. So why is it rallying? I mean, you look at Palantir. I told you guys, if you bought Palantir at $5 or $6, this was your time to take profit. Don't listen to Jeremy from Financial Education. Don't think this thing is just going to go to the moon in the next, you just don't know. You don't know what's going to happen here, folks. So it doesn't mean sell off all of it, but if you made good profit, just take some. Take a little bit off the table here, because you made fun of me. You made fun of me when I said it was expensive at 15 and 16. I saw your comments, and it went to 16, went a little higher, and it only took one day to get back down to the 14s. And this is when reality hits the hardest. Tesla, I'd love to buy Tesla. I'm hoping it pulls back. They're not even rallying on they just posted more news outside of the GM news for their charging network. I think they're partnering with Rivian, some other EV companies. That wasn't enough to drive the stock up anymore, because people are just getting tired of chasing it. We're seeing momentum plays here finally take a breath. Now let's talk about a few sides of the market. We'll talk about the US, Canada. I want to talk about what I'm seeing and what other concerns I do have, specifically with some of these kind of hideout stocks. I love Procter & Gamble. These are the kind of companies you can buy and hold forever. These are the companies that outside of tech have actually been holding up the S&P, because they're not trading high off their all-time highs. I mean, you take a look at Procter & Gamble and it's down 8%. It's hardly down at all. It's one of the biggest companies in the US at $350 billion, a toilet paper company, consumer staple kind of company. The problem that I see with these companies as well in the coming earnings is we are moving into a deflationary period. When inflation was skyrocketing, you don't need to buy a Tesla. As Elon mentioned, we're going to be cutting, margins. We're going to be lowering prices, doing everything we can, because we understand people don't want to be paying 6 to 8% on a vehicle. It's kind of hard to borrow money at this current time, especially when people are paying more on their mortgages. So they have to make it more appealing, which is, again, why I don't understand how Tesla's rallied so much. You really think any of that EV charging is going to hit the bottom line this quarter? I think you need to be very concerned about this quarterly earnings that's about to come up. Procter & Gamble, however, was posting record revenues. They've been doing fabulous through this recessionary period, and that is because you need toilet paper. You need these products. So what do? Well, it costs more for them to get the product, so they can raise the price against inflation, and you're forced to buy it. And when they raise the prices, it makes the revenue growth look amazing, and probably even increase it a little above inflation so they can keep their margins up. And that's going to come to an end here soon, folks. These companies will not be able to raise prices like they saw through the inflationary period. And what that does for them, I don't really know. Am I bearish on them? Hell no. I wouldn't be bearish on these companies, but you got to respect they're very valued here. I mean, these aren't the kind of companies Warren Buffett's buying. Hell, Warren Buffett has left the country, folks. He has gone to Japan. He is buying things like crazy over there. He does not want anything to do with U.S. stocks right now, because How can McDonald's trade at a 31 times multiple? You tell me, at an all-time high here. It's not just tech stocks taking us to the moon. Now, I own Pepsi. I love SCHD. I'd rather take the broader ETF, own a large basket of these and cost average into them, because as mentioned in 2022, the first quarter when I sold off all my stocks and started buying index funds, I don't know what's going to happen here. I don't know who's going to come out on the other side of this alive and doing well. So I'm going to take the broad view of all the companies and let them just kind of balance each other. Let them, the ones that don't do good get made up by the ones that do, because who actually knows what's going to happen? I sure as hell don't. So a lot of people think right now the lower half of companies are going to bring the market back. And JP Morgan is one of those lower half that got hit real hard and is rallying back. And a lot of people think the financial system is going to be in turmoil here. And I don't know about the US side of the border, but let's just switch the Canadian side, because that's what I want to buy individually. I do want to buy back my Canadian banks. Outside of a lot of the Canadian markets, I'm bearish on energy. I don't know how, in a time where oil depots in Russia are getting bombed, when this happened during the invasion, oil skyrocketed. We've heard OPEC are cutting oil production to bring prices back. We've heard bombings and oil field things going on at depots in Russia, yet oil is cyclically still going down. Does that make any sense? Doesn't make sense to me. Why is oil going down? I don't understand it. But that's going to hinder a lot of the energy markets in the coming quarters. Just like we saw oil rally aggressively, you want to be careful about that exposure, because again, it's such a cyclical. I do not like commodities. They're one of my least favorite exposures in all my index funds. I get when they do well, they do great, but they don't do great for long. They always end up coming back. Whereas things that do great for long are things like the banks. And people think in Canada, specifically the Canadian banks, and I've read Wall Street bet posts. I've been on Reddit, and people are saying that these things are going to be imploding. We're going to see for the first time in history a Canadian bank default. I don't think that's going to happen. And a lot of people are thinking it's because of real estate. When interest rates go up, people can't afford their mortgages. They're going to sell their properties. Yes, that is a fact of life. However, in that scenario, the problem is that we still have a supply and demand problem. And people like me want to buy. And people like me have cash. Canada is a very rich country. Toronto has a lot of rich people. And we're not obviously buying luxury real estate. That market is correcting. But the average home that someone might not be able to afford, there's going to be people there to buy it. And that's going to stop a mortgage crisis from happening. In my opinion, I could be wrong. I'd love to be wrong. I'd love to see a correction, but it's just hard to imagine it happening when you're paying attention to real estate as it sits today. It's still moving. Anything that's reasonably affordable is selling within a month, especially within the GTA. So do I think Canadian banks are going to go under? I find it so unlikely. And when they're trading down at the levels they're trading down at, I could see myself being a buyer here, and you just have to ride this wave. Get through the interest raised environment. We'll come out on the other side when things nominalize, and they're going to leave interest rates high, probably not as high as they are now, but these banks make more money. The Royal Bank made record revenues last quarter. That's because they tend to make more money when interest rates are higher. They are going to do well, I think, and I want to buy them. I want the fastest growing revenue banks, and I want to ride through this until it hits the bottom line. And when their EPS starts to come back, it's going to come back with a vengeance, and I'd love to be a part of that. So yes, when I sell off some of my ETFs and I rebalance the portfolio, banks are going to make it in individually. Now, let's talk about your telecom. You got to be careful right now with infrastructure companies, whether it's your utilities, your telecom, and they all have the same example I'm going to show you with TELUS here. I love TELUS, but this thing isn't, when I say a company is recession proof, people kind of misrepresent what I'm saying. I think it's recession proof. That doesn't mean the stock's not going to go down. I think the company will survive. I don't think they're going to go bust. Therefore, they are a recession proof business. They will be around. The problem is these companies tend to drop dramatically in recessions or, dramatic financial markets. I mean, this thing dropped 52%. In 2008. I mean, you go back to the dot-com bubble and this thing damn near dropped 70-80%. These are the things you have to prepare for. As Warren Buffett says, don't buy companies or stocks unless you're prepared for a 50% decline. It can happen at the drop of a dime. You got to be prepared. Why does this happen? Well, when we take a look at TELUS here, guys, like infrastructure companies, yeah, they have a lot of assets, 54 billion. Problem is they have 36 billion in liabilities. Those liabilities are going to start feeling the pain of interest rates. It's going to eat into their cash flow. It's going to probably hinder some of the revenue growth. Some of it's going to be eaten up by the population growth. We just hit over 40 million people. Not only does that bode well for the banks, not only does that bode well for real estate, these rich people coming over, it also bodes well for growth. When we have monopolistic companies that there's only a handful in each sector, they will benefit from that. That will cushion some of the interest raising cycle, which I think is actually going to cushion them better than it has in the past. Because over the last decade, Canada's seen one of the biggest, population booms than it even had in the, I think earlier 2000s. Don't quote me on that. I could be wrong. But nonetheless, it is something to be bullish on some of these companies to ride this market cycle. But again, these dividends are huge. I don't think they're going to cut the dividends, but you want to be a little careful with these and make sure you're looking at, again, before write-offs. A lot of infrastructure companies do write off a lot of their income, which does make it look like they can't afford the dividend. Because I'm sure if I go on Yahoo Finance and we just take a look, this is what everyone does. They go to the statistics. They're very lazy. They scroll down and they say, oh my God, its payout ratio is 135%. It's not. I promise you it's not. They do write-downs. If you don't know what a write-down is, I can't explain it in every video. I promise you right now they can afford the dividend. But there's just things you're going to have to pay attention to, right? So just be cautious with these. I still think they're good to cost average into. But again, just be prepared that if interest rates stay high or keep going higher, it could hinder a bit of the cash flow. From the real estate side, my other big concern with these REITs like Smart Centers, RioCan, that are doing a lot of development, I've been talking to some builders that aren't publicly traded, and they are worried. They are concerned. This also causes a supply and demand problem, because when you're a construction company that needs to build 50 homes, it's going to cost you $30 or $40 million, and you're not getting cash flow off that, and it's going to take you 3 to 5 years. Guess what? You're going to have to borrow that money at 6%. These companies, they're not immune to the interest rate cycles. They're not any specialer than you or I just because they have a lot of money. They're not going to get special below market rates. They might get a bit of a better rate, but they're not going to get anything below what the benchmark rates are, and the banks still need to make money. So they're going to be paying a lot to build new constructions, and that's what a lot of these REITs are going to get caught up in. Now, luckily, RioCan, Smart Centers, a lot of them have pre-sold out this into the future, which does give them some benefit to the bottom line with some deposits, which will help them ride some of this. I always think RioCan's a good buying opportunity under $20 a share. Here we sit at 19, but you do have to be concerned here that these companies are slowly going to see cash flow cycles come into play when their mortgages come due, and you want to find those REITs that are very financially balanced. I think RioCan's in a good position ever since the pandemic. Again, these are companies I would only buy for cash flow. I would not buy them for growth. $15 billion in assets against total liability of 7.3. They're very well capitalized. So, I kind of like RioCan still. I'm not against it. I think Canadian Apartment Properties is going to do better through this environment. Canadian Apartment Properties, one of Canada's largest retail, they're basically residential rental units. They're not dealing with, they're not dealing with malls. They're not dealing with, a lot of new builds. It's a very stabilized REIT, and I think it'll do better because obviously when people can't afford housing, they have to go to the rental market, and rental prices have exploded in the last year, especially in the GTA, Toronto, Ontario. They've got some global exposure in Canada, provincial exposure across all of Canada, and you're going to get a 3% dividend. It's not crazy, I know, but you're going to get some stability. Year to date, this thing's actually up, whereas a lot of the REITs are down. So I think they're going to do fine. If you're into the real estate market and you want rental income from a REIT, it's a good way to go about it. If you're looking for value, this is where we're going to have to do some digging. I'm looking at office REITs globally tank. US, they're just, everything's in the toilet when it comes to pure office. This company has exposure to the same deals that RioCan does, and this stock just continues to hit lows every month, every week. It just hits lower lows and lower lows. And I don't know if they think people are just giving up on office. Operationally, this company's cash flows are fine. Everything about it from a fundamental basis looks okay. Yeah, they're going to get hit on renewables and mortgages, but let's just take a look at the balance sheet. Allied Properties, man, this one blows my mind. 11.9 billion assets against 4 billion in liabilities, 4.7. Probably one of the most well-capitalized REITs on the market. I'm very intrigued on what your thoughts are on office REITs because, man, it has been rough for these guys. The real estate market's going to go through one of the toughest cyclical cycles they've seen in a while. I'm not going to be buying REITs. I'm going to just kind of remove myself from that because the real estate we're buying is still going to be extremely expensive. I mean, these condos, 2-bed, 2-bath, we're looking anywhere from $600,000 to $800,000, and we ain't talking luxury at those prices here, folks. But if I have to have that much exposure to real estate, I'm not going to be getting that exposure in my portfolio. I think it would just be from a diversification standpoint, just ignorant. But I'll pass this question off to you guys. Wow, what a market we've seen today. What do you think in the comment section below?